friends, I hope my videos are helping you. Friends, I have observed students are facing problem with balance of payment. So let us start today with balance of payment. Friends, let me tell you first of all about what is balance of payment. Friends, balance of payment is a summary statement of all economic, that is monetary transactions of the country with the rest of the world. During the given period of time, it is generally 1 year. These transactions may be made by individuals, firms, and governments of the country. Monetary transactions are related to export and import of goods. They are tangible and also called merchandise or visible trade. Exports and imports of services. They are intangible and also called invisible trade. International sale and purchase of financial assets. They are stocks and bonds. International sale and purchase of real assets. They are plants and machinery. Friends, the flow of foreign exchange, that is foreign currency, into our country via export and outflow of our currency to another country via import is recorded in the balance of payment account. Friends, let me tell you, all receipts are credit items and all payments are debit items. The balance of payment account reflects the performance of our economy in relation to rest of the world. Here are components of balance of payment account. First one is current account, second one is capital account, and third is official reserves account. What is current account? Friends, current account records receipts and payments of foreign exchange. Point to be noted is it do not impact the assets or liability status of the country in relation to rest of the world. That is, no rise in future claims. Friends, here are the items of current account balance of payment. They are exports and imports of goods. They are tangible, for example, cellular phones. Exports and imports of services. Those are non-tangible, for example, insurance services and banking services. Friends, services are classified into two, factor services and non-factor services. Friends, factor services lead to monetary transactions that are related to the payment made to the factors involved in production, or say this is a factor income, which is equal to compensation of employees plus investment income, which involves rent, interest and profit. And another is non-factor services, which include services other than factor services such as banking services or say insurance services. Friend, now comes current transfer. What is that? It is a transfer made by the way of gifts and grants by the relatives who are settled abroad. Now here comes current account balance. How will we get it? This is a trade balance, which is export minus import of goods plus invisible balance, which involves export and import of services. Friends, you must know our trade is deficit when our imports are more than exports, and our trade is surplus when our exports are more than imports. Here is a graphical representation of components of current account balance of payment, which is further divided into two, tangible and non-tangible. Friends, tangible goods involves exports of goods and imports of goods, and our non-tangible involves monetary transactions on exports and imports of factor services, which will include incomes that will be from investment income or compensation to employees. Then comes monetary transactions on the export and import of non-factor services. It involves shipping services, insurance services and banking services. Then comes current transfers like gifts and grants. Friends, they are unilateral, or we can say they are transferred for free. After current account comes capital account. Capital account records receipts and payments of foreign exchange which do impact the assets or liability status of the country in relation to rest of the world. That is, it lead to rise in future claims. Friends, let me tell you, components of current account has nothing to do with the components of capital account. Here are the graphical representation of components of capital account, which involves borrowings, foreign investments, NRI deposits, banking capital, and short-term trade credits. Friends, borrowings are of two kinds, external commercial borrowings and external assistance. External commercial borrowing means it is the borrowing available at the market rate of interest that avails in the international money market, and external assistance is available at concessional rate of interest. Then comes FIIs, that is foreign institutional investments. It is also called portfolio investment, which is made by the rest of the world in the shares and bonds of the domestic companies. Then comes foreign direct investment, which is related to the ownership of enterprises in the domestic economy. For example, Walmart stores in the India. Then comes NRI deposits. Friends, they are the deposits held by NRIs in domestic economy, and they are considered as a components of capital account. Friends, be careful. Point to be noted is money sent by the NRIs to their families in India is treated as a current transfer and it is added in the current account. Then comes banking capital, which refers to the foreign assets held by commercial banks. That means inflow of foreign exchange into domestic economy. Then comes short-term credit, which is availed at purchases of international market without making any immediate payments. So friends, after current account and capital account comes official reserves account. The overall balances is finally reflected in official reserves account of RBI because RBI is the custodian of forex reserves of the country. All forex transactions in the country are routed through RBI. Positive overall balances causes increase in official reserves and negative overall balances causes decrease in official reserves. Sometimes official reserve account is shown as a part of capital account balance of payment rather than separate account to balance of payment account. Friends, point to be noted is increase in official reserve is indicated by negative sign and decrease in official reserves is indicated by positive sign. Friends, here our balance of payment account come up as shown in the table below. Here are the name of the items in our balance of payment account and here are the figures. First, our exports are 2,80,138 and our imports are 3,92,588 and our trade balance comes to be 1,21,442. Friends, there are our invisible net balances, that is 97,147. Now our current account balance is 15,296. Here is our capital balance account, that is 36,482. And after errors and omissions, it is 364. Our overall balance is 21,550, which is considered as official reserves. And because it is positive, it is considered in negative sign, that is negative 21,550. So friends, here comes the equilibrium and disequilibrium of balance of payment account. Friends, our balance of payment account is in equilibrium when our current account plus capital account is equal to 0. And our balance of payment account is in disequilibrium when our current account plus capital account is not equal to 0. Friends, look here, our balance of payment account is in surplus when our current account plus capital account is more than 0. That is, inflow of foreign exchange into our country is positive. That means our official reserves are increasing and our balance of payment account is in deficit when current account plus capital account is less than 0. That is negative inflow of foreign exchange. That means our outflow of foreign exchange is more than inflow of foreign exchange, will lead to decrease in official reserves. So friends, at last comes the difference between balance of payment and balance of trade. Students are generally confused between both these terms. Friends, balance of payment is a summary statement of economic transactions of the country with the rest of the world. And in balance of trade, it is a difference between visible exports and visible imports. Balance of payment records a transaction related to goods as well as services. Friends, be careful. In balance of trade, it records a transaction related to goods only. In balance of payment, it records both current as well as capital account transactions. Whereas in balance of trade, it does not record the capital account transactions. In balance of payment, it always balances, provided movement of RBI reserve is reflected in it. Whereas in balance of trade, It is either positive when exports are more than imports, it is negative when exports are less than import, and it balances only when export is equal to imports. Friends, that is all for the today. I hope you like the video and do subscribe it if you really like the video. Thank you. Bye bye. See you.